How to read a financial report. Whether you're a seasoned investor, a budding entrepreneur, or just someone curious about how businesses manage their money, you're in the right place. By the time we're done here, you'll be navigating financial statements like a pro. Financial reports are like the pulse of a business. They tell us how well a company is doing financially, where its money is coming from, and where it's going. For investors, they're essential for making informed decisions about where to put their money. For managers, they provide insight into how efficiently the company is operating and where improvements can be made. Let's start with the basics, the three main financial statements. Number 1, the balance sheet. Think of the balance sheet as a snapshot of a company's financial health at a specific point in time. It lists what the company owns, aka assets, what it owes, aka liabilities, and what's left over for the owners, aka equity. Assets can include things like cash, inventory, and property, while liabilities might include loans, accounts payable, and taxes owed. Equity represents the portion of the company owned by its shareholders. Number 2, the income statement. Next up, we have the income statement. This document provides a summary of a company's financial performance over a period of time, usually a quarter or a year. It shows how much money the company made, aka revenue, subtracts the expenses incurred in generating that revenue, and gives us the bottom line, the profit or loss. Number 3, the statement of cash flows. Finally, we have the statement of cash flows. This statement tracks the actual flow of cash in and out of the company during the same period covered by the income statement. It's like following the money trail through the business, showing where cash is coming from, aka operating activities, where it's being spent, aka investing activities, and how the company is financing its operations, aka financing activities. Now that we know what each financial statement does, let's dive deeper into the balance sheet. One of the key things to look for on a balance sheet is liquidity. This refers to a company's ability to turn its assets into cash to meet short-term obligations. You can assess liquidity by comparing a company's current assets, like cash and accounts receivable, to its current liabilities, like accounts payable and short-term debt. The balance sheet also gives us insight into a company's capital structure, which is the mix of debt and equity financing it uses to fund its operations. By comparing the amount of debt to the amount of equity, we can assess how leveraged the company is and how much financial risk it's carrying. Finally, the balance sheet helps us understand a company's working capital, which is the difference between its current assets and its current liabilities. This represents the funds available to the company for day-to-day operations and can give us an indication of its financial health in the short term. Moving on to the income statement, let's break down some key concepts. The income statement starts with the company's revenue, or the money it's bringing in from sales of goods or services. From there, it subtracts the expenses incurred in generating that revenue, such as the cost of goods sold, operating expenses, and taxes. What's left over is the company's net income, or profit. Profitability is a key metric to consider when looking at an income statement. Analysts often look at metrics like gross profit margin, operating margin, and net profit margin to assess how efficiently a company is generating profits relative to its revenue. Now let's turn our attention to the statement of cash flows. The first section of the statement of cash flows focuses on operating activities, which include the day-to-day operations of the business, such as sales, purchases of inventory, and payments to suppliers. This section shows us how much cash the company is generating from its core business activities. The next section covers investing activities, which include buying or selling long-term assets like property, plant, and equipment. This section gives us insight into how the company is investing in its future growth and development. The final section of the statement of cash flows deals with financing activities, which include raising capital through loans or issuing stock, as well as paying dividends to shareholders. This section shows us how the company is financing its operations and returning value to its shareholders. In addition to the financial statements themselves, analysts often use financial ratios to gain deeper insights into a company's financial health. Efficiency ratios measure how effectively a company is using its assets to generate revenue. Examples include inventory turnover, receivables turnover, and asset turnover ratios. Liquidity ratios assess a company's ability to meet its short-term financial obligations. Common liquidity ratios include the current ratio and the quick ratio. Leverage ratios measure a company's use of debt financing relative to its equity. Examples include the debt-to-equity ratio and the interest coverage ratio. Valuation ratios help investors assess whether a company's stock is overvalued or undervalued relative to its financial performance. Examples include the price-to-earnings ratio and the price-to-book ratio. When analyzing financial statements, it's important not to overlook the footnotes and auditors' reports. Footnotes provide additional context and detail that may not be apparent from the financial statements themselves. They can include information about accounting policies, significant events, and contingent liabilities that could impact the company's financial health. Auditors' reports provide an independent assessment of a company's financial statements. They confirm whether the statements have been prepared in accordance with accounting standards and provide assurance to investors about their reliability. So, in conclusion, understanding financial reports is essential for anyone involved in business or investing. By mastering the basics of financial statements, analyzing key metrics and ratios, and paying attention to footnotes and auditors' reports, you can gain valuable insights into a company's financial health and make informed decisions about where to allocate your resources. So go forth with confidence, armed with the knowledge you need to navigate the world of finance. Thank you for watching. Don't forget to like, comment, and subscribe. Watch more videos by clicking on this video right over here.